Okay, so we're going to look at this strategy now. We've already talked about the different ingredients or the different tools that make up the strategy. All right. So this strategy is a trend following strategy. What we aim to do is to look for a trending market and join that trend at the end of the correction. We want to be trading the impulses in the direction of a trend that we have already established. And we're going to be needing three major tools for that. We're going to need the moving averages, the relative strength index, and we're going to be making use of trend lines. Of course, we're going to be making use of divergences as well. We're going to talk about that when we get to the fine tuning class. Of course, I've told us what divergences are. So moving average. So we're going to be making use of three different moving averages. I've already told us how we can plot moving averages, right? We're going to be making use of three different moving averages. We're going to make use of the 200 moving average, and we're going to use the 250 and the 300. And so what I have on the screen is how the moving averages will look like. So the idea is that, okay, we have two purposes, okay? The moving average is going to serve two purposes. Number one, to help us establish the trend. So when the price breaks above the moving average band, the three moving averages, we call them the moving average band. So once the price breaks out of the three of them upwards, it means that we are in a bullish trend. All right. It means that we are in a bullish trend. And when the price breaks below, like what we are having here, all right, it means that we are in a bearish trend. And what is the implication of that? When the price broke upward here or breaks upward here, we're going to be looking for what? Bullish opportunities. That means buying opportunities. That's what we're going to be looking forward to. And when the price breaks below the moving average band, we're going to be looking at what? Selling opportunities. So that's the first use of the moving average band. Now, what is the second use of the moving average band? The second use of the moving average band is that we want to use them as support and resistances for our corrections. Remember, what we want to do is this. We want to look for a trend. A trend consists of impulses and corrections, impulses and corrections, impulses and corrections, impulses. And remember, we said that what we want to do is we want to trade the end of the corrections. We want to identify the end of the correction and trade the next impulse. Identify the end of the correction and trade the next impulse. Identify the end of the correction and trade the next impulse. That's what we want to do. All right. That is just what we want to do. We want to trade impulses because impulses are movements in the direction of the trend, and they're usually swift, they're usually fast and big. So you can make a lot of money doing that. Okay. So when price is making a correction, since that we have been able to use the moving average to establish a trend, we are going to wait for correction. That is what you want to do. And the moving average can help us to identify where the correction could end. Now, I talked about where, when, and how yesterday, okay, about the termination of a correction, okay, because if we want to trade impulses, all right, if you want to trade the end of corrections, impulse correction, I want to trade the next impulses, we need to know where this correction could end. And so the moving average can help us to do that. How does it do that? So it does that by this is how it does it. When the price breaks the moving average band, we wait for correction to back to that band. So we want to use the band as a level of resistance in this case, or as a level of support in this case. So once the price breaks, makes a correction into the band, that is when we start looking for the end of the correction. So where can the correction end? According to our strategy, around the band area. Okay, once it touches the 200 or it goes deeper into the 250 or it goes even deep into the 300, or maybe even go a little bit lower before it shoots up, that's the end of our correction. Same thing here. When the price makes a bullish correction to the band, does it touch just the 200, 250, or 300, or it moves a little bit above? That is what we want to see. The minimum is to touch 200 moving average band. All right. So that is the second function of our moving average. So we want to use it to identify where our correction could end, so that when we know where the correction could end, we can then trade the next impulses. All right. So that's the second function of the moving average. Remember, the first function is that we use it to identify the start of a trend or to establish a trend. And the second is to use it to identify the end of a correction, where the correction could end. When the price makes correction back to the band, we can take that as a possible place where the correction could end, and then anticipate trading in the direction of that trend. All right. Okay, just like what we have here in the earlier slide. When price broke above this moving average, we have a bullish trend established. So the next thing we're now going to do is wait for correction back to the band. And you can see as the correction, as the price corrects to the band, what happened next? It pushes up. So in this case, what we have there is you have a trend, a correction, or let's say an impulse, a correction, and then an impulse. So we will have been able to trade this impulse here. Okay. So when price gets here, it's a sign that the correction has ended, and then we can start anticipating a bullish move upwards. Okay, because this is a bullish trend. We're only looking forward to buy. We're not going to sell here. We only want to buy when the price corrects to this place. All right. So those are the two things we use the moving average for. All right, now, so let's see what happened next. All right, so this is an example that we have here now. As the trend progresses, there comes a time when the market will make retracements or counter trend moves before deciding whether to continue the trend or make reversals. The moving average band can help identify possible price regions where the corrective bounces or dips could end. That's what I just talked about now. So look at this example. This is the first thing here. Price broke below the band, and you can see the bearish trend became established. That's the second step. We want there to be a break here to identify the start of a possible bearish trend. You want the trend to become well established, and then you wait for correction to the band. All right. And then brand now offers a kind of resistance, and then you sell. Now, this is where you get the trading opportunity here. Okay. Not here, but here. Here is where we get the start of the trend, and we watch the trend to get established. Then wait for a correction to the band. We now look at the band if it's going to offer us some resistance, and then we sell. This is where we can now look at for our divergence. We talk about divergence on Monday. The divergence is, we can use divergence to identify the end of a correction. Okay. And then we sell downwards. Okay, the same thing in a bullish market. So price broke above here to establish the bullish trend. The trend gets established, and then we got a correction to the band. The band offers support, and price goes up. So this is where we will have bought this instrument after price gets to this band and goes up. So that is just the foundation of it. All right. So let's look at some other tools that are very important. Now we're going to look at the RSI. We already talked about how useful the RSI can be. Okay. Because we need another tool to support the moving average band, offering support or resistance. So when the price comes here, we also want to, because I told you guys that we talked about the overbought and oversold for the RSI, right? And we said that The best way to use this overbought and oversold is when the market is trending. If the market is trending up, you don't look for overbought. You look for oversold and buy. Because when the price is trending up, you want to buy. When the price is trending down, you want to sell. When the price is trending up, you don't want to go counter trend. You want to wait for the end of a correction. Well, at the end of the correction, you look for oversold on the RSI and then you buy. The trend gets established again, you look for correction. Correction starts, you look for oversold signal on the RSI, and then you buy the next impulse. So when the market is trending up, you look for oversold. Also, when the market is trending down, you look for overbought. That's what we talked about. Look for bullish correction, identify overbought, sell, bullish correction, identify overbought, sell. So the overbought on the RSI or the oversold on the RSI is what helps us to know when the correction is over. This moving average band here helps us to know where. So the where and the when, they have to happen together. Okay, they have to happen together or consecutively. All right. So we have to see the two of them before we can say that this correction has ended. So we have to see the where. Price has to touch the band. The correction has to touch the band to help us confirm the where. And then we also have to see the RSI at those extreme regions to help us know the when. Okay, so that means you can know when and where the correction could end. So that makes your job to be really, really very simpler. Okay, so let's now go to the RSI proper. Now you can see this is the RSI here. And just like we said, when the price is trending up, the best way, okay, is to buy the dip and use the RSI oversold. You can see the bearish dip here, bearish correction, RSI is equal to 30, less than 30 even, and then price goes up. Here also, you can see each time price gets into the oversold region, that is when it pushes up genuinely. You see that? That's where you see the continuation of the bullish trend. How many times? 1, 2, 3, 4, just 4 times. But when it was going up, how many times did it touch the overbought? Many times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Because it's going up. When price is going up, the RSI is going to be touching the 70 region often, very often, okay, because the price is in a bullish trend. So that is why you don't want to look for signals overbought signals, okay, when the price is trending. You only want to look for oversold signal, all right, because you want to trade upward, all right. Once price gets here, you buy. Once price gets here, you buy, all right. And if at the same time this now coincides with the touch of the moving average band, okay, then it makes more sense, because this one is talking about how, sorry, not how, this one is talking about when the correction has ended, when the RSI touches 30, okay, or below, where, when the correction touches the moving average band, and it two really needs to happen together. So the same thing when the price is trending downwards. So you're going to make use of the overbought RSI indicator. All right. So you look for it to get to 70 or more. Okay. And then you can then confirm the end of correction and sell. As you can see, we didn't also have, since this trend started from here, this bearish trend, we didn't have too much touch of the overbought region, but we had so many touch of the oversold. 1, 2, 3, 4, 5, 6, 7, many of them, right? Which a majority of them are actually false signals. So we got the real signals. At the top, overbought regions, because the price is trending downwards. All right. So if this now also coincides with the correction going back to the moving average band, then the when and the where is done. So that means we need to now talk about the how. How do we now go about it when we get the when and the where done? Okay, so there are two ways to get that done. There are two ways actually. We're talking about the how now. Talking about the how. And one of the hows, one of the things I love to see is divergence. I love to see divergence. We talk about the divergence, right? We talk about divergence. I always want to see divergence. Okay, once I see divergence, I also want to see a trend line break. Okay, we also talk about trend line break also. Okay, when we're in the beginners, when we're um at the very beginning level of technical analysis. Okay, introduction to technical analysis. So this is what trend line break means. All right, you can see these trend lines connecting the eyes together. And once the price breaks above them, it goes up, connecting the lows, breaks below them, lows, break below them. So you need to practice this. You need to practice how to use the trend line. Maybe you check some of the past videos, all right, for you to, so that you can get that quite well. I've talked about divergence also in the last class. So please revisit that as well. We're not going to talk so much about divergence now. Okay, so, but divergence and trend line is what we use for our how. Moving average is what we use for our where the correction could end. And the RSI at overbought or oversold is what we use for our when the correction is going to end. So if you know when it's going to end, where it's going to end, and how it's going to end, then you have a complete outlook, okay, that you can use to trade the end of that correction. Remember, what we want to do is we want to see an established trend, wait for a correction, and sell in a bearish trend. Wait for a correction and sell. So our job is now to investigate this correction. Where is it going to end? Use the moving average band. When is it going to end? You look at the RSI, overbought, oversold. That's when it's going to end. Then how is it going to end? You can check the divergence or the trend line break, and that's it. Okay, so it's quite very straightforward. But of course, it requires us to practice very well. So let's now put all of these things together. So the first step is you plot your three moving averages, and then you plot your RSI, and then do your analysis on the fifth. I've actually changed the 15-minute time frame now. Okay, now I so much prefer the 15-minute time frame. Of course, you can do this on any time frame of your choice. Okay, this strategy works on any time frame, but I will advise you that you just stick to one time frame. Whatever time frame that you choose, stick to it. If you are somebody who does not have time, you can use the 4-hour time frame or daily time frame. If you are somebody who has time, you can use the 15-minute time frame or the 1-hour time frame. Okay, so it all depends on what time you have, okay, on your hand. Even if you are busy at work, you can still use the 1-hour time frame. I think so. All right. So that's the first thing you need to do. Identify what time frame you want to trade with, and then plot the three moving averages and the RSI on your chart. All right. The second thing is, we're going to do all that. Let me read first. The second thing is bullish trend is when price breaks and stays above the moving average band. Okay. Bearish trend is when price breaks and stays below the moving average band. We talked about the importance of this. The importance of this is to help you know the direction of your trades. The third thing is you need to wait for a retracement to the moving average band, whether to the 200 moving average or to the one at the middle or to the biggest, which is 300. Okay, a minor break above or below is can happen. Okay, if it's just a minor breakout of the moving average, can happen. It's okay, in as much the price comes back quickly. Okay, but when the retracement breaks sufficiently above or below the band in the opposite direction, then we'll have to discard that retracement. What we are saying is you have your moving average band like this, like this, like this, three of them, and then you now have your price breaks above them. So when the price break now goes sufficiently upwards to establish the bullish trend, when it's coming back, by the time it's coming back, the band, they will have also, they are moving average. They will have also turned around, follow this upward move here, turn around, coming to meet the price. All right. And then when price comes here, this is a correction to the band. This is when you start looking for opportunity. Once price touches here, yeah, sometimes it can go here, sometimes it can go deeper, or sometimes it can go slightly below them. What we are saying is that if it goes slightly below them and quickly moves up, it's accepted. It's an accepted correction. But if it goes and stays below them, this is a breakout. It's no longer a correction. So that means price has now breaking below the band. We can now start looking for selling opportunities instead. All right, that's what I'm trying to say there. Okay, so when the price makes correction to the band, we need to know that yes, the band is going to offer some sort of support or resistance. Okay, so that price can then turn around and start in the direction of the trend. But if it breaks the band and stays there consistently or sufficiently, then it means that we have now moved from a bullish trend to a what? A bearish trend. So instead of us to look for bullish opportunity, we can now start looking for a bearish opportunity. So that's what we're saying there. Okay. So number 4, confirm retracement exhaustion with RSI. RSI 70 and above for bullish retracement and 30 and below for bearish retracement. So what we're saying here is that when the price, let's say this is a trend above the band, then we have a correction back to the band. Let's say this is the band. Once the price gets here now, you want to confirm that the RSI is at 30 or below. Remember, this is the where. You also need to confirm the when. When will the correction be over? When the RSI touches 30 or below. So that means once price touches this place, you need to confirm with the RSI as well. If the RSI is also around the oversold region, then that means the where is ticked, the when is ticked. Then you can now move to the how. All right. So if 3 and 4 are confirmed, then you can look for a divergence. I did not add divergence to this. So because we have two hours, we have divergence and what? And the trend line break. Okay, divergence first, then trend line break next. Okay, but divergence is not that compulsory, but I love it because it actually it will increase your winning rate. Actually, I believe that. Yeah, I've confirmed that it will increase your winning rate. So you can wait for divergence first and then look for trend line break next. Those are your hows. So once price touches the moving average, once the correction touches here, and you've confirmed the RSI, the next thing you start looking for divergence. Once you see divergence, then you wait for trend line break and then you buy. Simple. Once you buy, you put your stop loss below the end of the correction, and then you can target ×3 of the stop loss. I'm going to show us all that on the chart. Okay. And also, when the price is going down as well, you have this trend, bearish, and then you have a correction here back to the band. This is the band. Once the correction gets to the band, then your job next is to look for the RSI, because this is the where. Then you need to look at the when. So which means that the RSI needs to get to 70 or above. Once the RSI gets to 70 and above, then you then go to the what? To the how. You then try to investigate divergence. Can you see divergence there? If there's a divergence there, then you plot your nearest trend line. And once price breaks below the trend line, you sell. You put your stop loss at the top of the correction, and then you target ×3 of your of whatever you are risking. So it's just like that. That's how the strategy works. Very simple. So let me quickly take us through how we can do our chart and all that. Okay, before that, I think we still the slide has not yet ended. Okay, so this is an example here. So this is the first step. Now, initially price was bullish. And then what do we see? Price broke below here and then stayed consistently or sufficiently downwards to give us a what? A bearish trend, right? We have a bearish trend established. Once you have a bearish trend established, the next thing you wait for correction to the band. Now the correction to the band happen, then you confirm because this is where the correction could end. Then you confirm whether the correction has ended or when it has ended or whether it has ended with the RSI. Now the RSI is above 70, it is the 70 line, which means that it has ended. Then you can investigate a divergence. For those of you who were here in the divergence class, this is a divergence. You can see this top here, giving us a kind of double top while this gun is slanting down. Now that is a divergence. Then you now plot your trend line. Can you see this trend line? And when price broke below the trend line, that's where you sell. This is selling price. The stop loss will be here. And then you can target triple. You can see our price went down. Okay. As it went, as it, it went down. This one, like that, it the target. Now, what we're also having here is prices moving back to the band here now. Can you see that price is gone to the 200 moving average, which means there's another trading opportunity here. So the where is done. What about the when is done too, because the RSI has touched the 70 moving average at the 70 overbought region. So the next thing we now investigate a divergence. So far there's no divergence yet, but if we're able to get a divergence here, okay, if we're able to get a divergence here, let's say price just goes up and we have this like this, and then we can, this is higher high, and let's say this is a lower high like this. We get there's a divergence. I will now plot our trend line and price breaks below it, then we sell. I will put our stop loss here and target times 3 again. So that's just how it works, guys. Very simple. Okay. So it's step by step, step by step. Um, So let's look at another for a bearish, bullish market. Now look at this one. Price broke above this moving average band and stays consistently above it. That's the first step, a bullish trend. The second step is a correction. Now we had a correction to this band, which means that when it's done. But what about the RSI? The RSI didn't touch 30. Can you see that? The RSI didn't touch 30 and we needed to touch 30. So if it doesn't touch 30, then we're not going to consider this as a tradable correction based on this strategy. Okay, we'll not consider it as a tradable correction. We'll have to wait for the RSI to touch 30. So, but eventually RSI touched 30. And this one is just slightly below the band. We say that a slight move below the band is good. This is not a break, a sufficient breaker. It's not like this one. Okay, price broke slightly below and then quickly moved back to the band. Then we're going to plot our trend line, and price breaks above our trend line, then we do what? We buy. Maybe there might be some divergence here. We might investigate, but like I said, divergence is not that compulsory. Okay, if you don't find the divergence and you want to take it, you can take it. But personally, I love to see a divergence. So in that case, maybe I would not have taken this trip because I can't really see any divergence here. All right. So this is a lower low, and this is a kind of a lower low. So it's not really divergence. But as you can see, even without the divergence, price moved up. Okay. And so that's just the two examples I can put together from this. So let's go to the chart now. Okay, so the first thing you need to do is you need to learn how to, you need to be able to prepare your charts. You need to be able to prepare your charts. So I'm gonna take us here now. So let's open a fresh chart. Let's say Euro US dollar, or let's say GBP US dollar. Chart window. So you can see my moving averages here and my band. See that? So I'm going to remove everything in case you still don't really know how to plot this. I know we did this yesterday. So let's say this is your chart and you want to put all our different tools there. Just go to indicator, moving average. You're going to start with 200. You can use blue for that. Make sure the exponential and shift to 0, apply to close. Okay. Then you put another one there, 250. And you change the color, red. Make sure it's the exponential, right? Apply to close. They put in another one, moving average. They put 300, exponential also, change the color. I'm going to use black and okay. So that's how this one was plotted. And then you put in the RSI. So this is the RSI here. I'll just go to oscillators and then choose the RSI, relative strength index. And then you parameters, you choose 14. Your levels should be 30 and 70. If you don't have them, you can add them. Just click on add and type, double click and type the level there, 30. All right. Add 70. All right. And then you click OK. But because I have them, I already have 37, I can just delete these ones. So I have 0, 30, 70. And then I want it to be a bit thick. That's why I chose the second line. And I think that's all, right? Okay, so this is my RSI here. So like there was a trade on GBP USD this week. Price broke below the moving average band here and makes a correction to the band, right? And when we got the correction to the band, what happened? We have the RSI also went above 70, which means the when and the where is done. Then the next thing is how investigate for a divergence. We have higher high here, and then we have lower high here. That's the divergence. And then you plot the nearest trend line. These two lows, I can connect them. And when price broke below here, I sell here. Stop loss is going to be above here, maybe 27 pips, and you can sell price went down. You'll have been able to take 1 to 3 risk reward ratio or more from this very easy. Okay, that was a really very good trade. Okay, so that's just it. So I'm going to take you to my trading view quickly because it is there. I've been able to mark all those so there I've been able to mark all those setup. There was even a trade that happened today on the Euro Yen. We have Euro Yen, Euro Aussie, and Euro New Zealand dollar. Those trades are very fantastic. Let me share those setup with you guys. Okay, so you can see this. This is Euro Yen, right? So we got a trend starting here. Price broke above it, and then the trend got really established. The first time we got a correction back to this band, you can see we got a divergence. That's why I love divergence. If you did not include divergence, you will have gotten it, you will have gotten in with this move. But if you wait for divergence, it's going to reduce the number of fake signals, or let me say false signals, and then it's going to increase your winning rate. That doesn't mean you're going to win all of your trades. So that it's going to increase your winning rate. So you can see the divergence here. Price broke above this two top, the trend line I dropped with this two top, this red line, and you can see where it moves up. It hits the target today very, very fast. There was also one on Euro Aussie. Yeah, you can see this divergence also. Another one here on Euro Aussie on 30th August, yesterday. Then today, Euro Aussie. You can see our price made correction to this place. You can see the divergence. You can see the divergence, right? Double low, lower low, higher low, and price broke the trend line. Then after breaking the trend line, that's a bullish trade. That's over 3.02 risk reward. In fact, he even did more, right? That's over 5 risk reward, but 1 to 3 is good. And this one did 1 to 3 today, although I didn't really take it because I didn't get in early. I love getting it on time early. So the one I took today was Euro Yen, but I took this one Euro Aussie yesterday. And then GBP USD, the one I told us when we look at the MetaTrader 4 is this one. Okay. So that doesn't mean that the trade, the setup is always profitable, because I've already marked all the different traits that I was able to pick on this instrument. Let me go to okay, let's just go here. Let's start with Aussie dollar this month. Now look at the Aussie dollar. The Aussie dollar gave how many trades this month? You have 1, 2, 3 on the 15-minute time frame, and all the 3 trades. Okay, this one won. You can see the trend established, price make a correction right into this place. Then we have a divergence. This one giving us double top, I giving us lower high. Price broke below, and then we got in. Another one here. This is also the trend we established after we pick profit from it, because this one will have even given a 1 to 4 risk reward or more. But 1 to 3 is good, which means that target was gotten to sufficiently, and we got another correction here. If we waited for divergence again, you can see the divergence here. So another divergence, trend line break, another sell. 1 to 3 risk reward there. Right? And another one here, divergence. Although we had a slight break, the price quickly went up, and then we got a buy. That's another 1 to 3 risk reward trade. So Australian dollar was really very profitable for the system this month. All the 3 trades were winners, fantastic. But euro dollar, let's look at what the setup we got for euro dollar. Now this one will have gotten into this one, but we couldn't really get a divergence. But for those people who will not be using divergence, they will have gotten into this euro dollar, made money on it from it today. Okay. So just like I'm saying, divergence is not compulsory, but I just like using it as part of my ow. So you can see this euro US dollar setup. You can see this divergence here, price making higher high here, and then momentum making higher low. And we got a break of the trend line, then I got a sell. You can see the trend well established, the correction back to the band, and then the send downwards. So you can see these are trends. So this strategy works best when the market is trending. So we need to look for a market that is trending. All right. And so this one was a setup that failed, that lost money, that was a losing trade. All right. So we got the price broke below here, and we got a correction to the band. And of course, that was divergence and trend line break, but price just moved down slightly, maybe like 20 pips, but couldn't really get to target. Target will have been around here, 1 to 3 risk reward. But price just moved down 20 pips and quickly moved up, and then hit the stop loss here. So euro US dollar gave like okay, only just 2 trades this month, 1 win, 1 loss. But if we don't consider that, if we don't consider divergences, one will have taken this one as well. So that's just it, guys. Okay, let's look at maybe 1 or 2 more. So GBP Japanese yen, this one didn't really give any meaningful trade. As you can see, there was no really meaningful trade. What we want to do in the fine-tuning class is we're going to talk about how, apart from price just breaking above or below the moving average band, okay, how do we really know a trending market using the moving average, apart from just when it breaks? Because here you can see it breaking up and breaking down, breaking up and breaking down. How do we know? Because you can't be entering into a trade like this. There's a way we used to sieve this. Okay, we used to identify whether the market is really trending or not. Okay, that's what we want to do in the fine-tuning class. So because of that, there was no meaningful trade on GBP in August. But GBP US dollar had some really good trades in August, right? And this was a trade here. You can see we already talked about this. That's that's the last trade this month. We also had another trade here. You can see the trend line, the divergence rather. So you can see the divergence there, right? Price broke below and then continued to move down. And I can see a very good trend correction to the band. This one was a losing trade. We got a divergence. Price moved down by like 30, 40 pips, but didn't really get to target. Okay, target will have been 1 to 3 risk reward. Maybe around that, about 100 pips, but price didn't really get it before it shoots up. So in August, we had just 3 trades for pound dollar, and there are 2 wins and 1 loss. So let's look at this as the last one. Okay, so this is this US dollar Japan. We didn't get any trade here, all right, because I think the RSI didn't really touch this 30 here, although price gave us a very good trend, made a very good correction to this place. And so we have the trend, we have the when, but what about the okay, we have the where, which is price touching the band, but what about the the RSI didn't really give us 30. I had to really squeeze it up to see very well. But I will have really just taken this actually because it was really, really very close. If it's not 70, then maybe it's just 70.2 or something, very, very close. But the more of the reason why I didn't take this was because I can't really find any divergence here. You can see the 2 of them are making lower lows. But people who don't use divergences, okay, will have maybe pick something. Yeah, but that wasn't really a trade for me. So let's look at the one I took on US dollar Japan. And then I took this on US dollar Japan, which was not a good trade. It was a losing trade. So there was a divergence here, of course. Price broke downwards, nice trend, nice correction, divergence. And then we have the trend line break, and then we got in, then it lost, didn't even really move at all. So, but there was a good one here. So we got a divergence also to confirm the end of the correction. So you have a trend. This one will have been a correction, but RSI didn't touch 30. So we'll ignore it. So this is the real correction here. Touch 30, price got to the band, divergence, trend line break, enter 1 to 3 risk reward done. And so that's just also 2 trades there. 1 trade. So that's also 1 win, 1 loss. So when you go through all of these different when you go through all of these trades, when I did the back testing and all of that, of course, you guys saw that the trading result, of course, that I showed you guys. So that was the strategy I used to trade those to take those trades. Although I have to say that I didn't also even really apply them very much the way I supposed to. Okay, but when I did the back testing, the strategy this month, August, was really, really very impressive. It had let me check. Okay, that 14 wins and 11 losses. So which is on 1 to 3 risk reward. Okay, you got to let you know how impressive that is. And so that's actually more than 50%. So that's why I say that sometimes you make more than 50% of the wins. So what this means is that, let's say these are 25 trades, right? Let's say you even you're able to take, one is able to take all of these trades. If one is really, really very effective, you have a very good trading routine, and you're really very consistent and very disciplined, you're able to take these 15 trades, because all of these trades happen during the day, Nigerian time, okay, between 7 a.m. or 8 a.m. to maybe around that 8 a.m., 8 p.m. All right. That was when all of these trades came up. So I didn't consider the ones that happen in the midnight. All right. So let's even say if you risk 1% on each trade, which means at the end of the month, you have the total of 25% risk on your trade, on your account combined. 14 wins will have given you, because every win that you make is going to be 3%. We multiply that by 14. That's going to be what? 52. Positives. What about the negatives? -1 for every loss times 11. That's minus 11%. So net will be what? 41. Marvelous. Marvelous. This is very, very marvelous. Now, I'm not saying that it's going to be the same every month, because I think last month was not really as good as this. Last month was profitable as well, but it wasn't as good as this. While June was close to this. June was really close to this. June was also like 50% winning rate. Okay. But this August is really, really very impressive. It's about 56% winning rate. Massive, very, very massive. Let's now say you risk 2% on every trade. That's going to be a whopping 81% ROI on your account. Okay. So this is something that can make you money if you learn it very well and you apply with discipline. It doesn't really mean that you're going to lose trades. You're not going to lose trades. All right. I've shown you those trades that were profitable, and I've also shown you those that didn't go right. So that doesn't mean because you say it's profit does not mean that you have to be winning every trade. So these 11 losses, out of them might be 2 consecutive losses. So maybe the first 2 trades you're going to take will be losses. So if you now give up because of those 2 losses, you will not be able to take the wins. Okay. So that's just a strategy. So what we want to do next is to fine tune this strategy. And what do I mean by fine tune? Number one, we're going to talk about market environment, how to really identify a trend, a really, really trendy market. I'm going to teach you the different market environment that we can have. Okay. And then number 2, we're going to talk about entry, proper entry method, how you can get in early so that you'll be able to achieve the 1 to 3 risk reward early. You don't have to wait so long, maybe in a day or maximum 2, to trade that it take profit. All right. So those are the 2 major things we're going to talk about. And then number 3, trade plan. All right. Trade plan. All right. And 4, how to keep a trading journal. So these are the things we want to talk about in the fine tuning, and that I believe is going to complete everything and give us a whole package. Okay, something that we can use to make money in the financial market. Okay, so that is where we're going to end for today. I said we're going to end by around that 7:30, so it's almost 7:30 now. Okay, so if you have any questions, please ask a question as I end the recording of this today's class. So thank you very much for joining, guys. So let's go to the question and answer session.